My next guest is Shane Oliver from A&P Capital, and I want Shane to get to the bottom of this housing bubble story. I won't call it hype because that would be I'm being biased. So the story that's going around, and we'll get his mild-mannered view on the subject, mate. What do you think? Housing bubble. Welcome, first of all. Well, housing bubble.
Great to be here. Great to be here.
Are you worried about housing bubble in the Australian context?
I'm a little bit concerned, but I think there's a lot of hype around this. And I like the comment from Malcolm Eadie a week ago where he said that it's a bit rich to every time that house prices rise above average, which by definition is 50% of the time, to suddenly reach for the bubble terminology. And the other funny thing I noticed was that a year ago, when I put out a note a few months ago on Australian housing, the one before that was about a year ago, middle of last year. And at that point in time, the big concern in Australia was about how house prices were going to crash. We had all these foreign hedge funds staying away from our banks for fear of a house price collapse. There was a report by a guy called John Malden, I call him Maudlin for some reason, saying that Australia is just a one-trick pony all driven by mining. It's collapsing, so we're going to become crashing down as well. Sayonara house prices here, down 30%. None of that's happened, and now we've suddenly swung in the space of 12, 18 months from there's going to be a house price crash to suddenly there's a house price bubble. So,
and the thing is that it's driven by media commentators. I'm not seeing a real lot of economists, like the Reserve Bank hasn't jumped on the housing bubble. They're watching, as is their job.
Well, as you would do, and you need to do that. It's almost like a knee-jerk reaction. Interest rates have gone to record lows, housing has picked up, and there's no doubt that it has, and therefore we start to think, oh, well, you know, we've had a few bubbles last decade, maybe we're going to have one straight away now. But yeah, it is interesting when you look at most of the economists out there, they're not talking about a bubble, they're saying the risks are there. But it's not quite a bubble yet.
And Shane, and a lot of your respected colleagues, and I know there's always rivalry between A&P, Westpac, Combat. Between chief economists.
All friends.
But yeah, like Brian Redican, he thinks there's 2 more rate cuts. I think Bill Evans has probably got 1 or 2.
I think he's got 2.
NAB's got 1 now. It could be 2 as well.
They move around a bit, as we all do.
But the thing is, if they thought a housing bubble was a chance, they would wipe it off the board, wouldn't they?
Well, they would. You know, that's entirely
true. Logical.
I mean, there's lots of issues here. I think as an economist, like when I did my PhD thesis back in the 80s, early 90s.
Housing bubbles.
Well, there's a whole chapter in there on housing bubbles.
Oh, you actually did in your chapter?
I did. Okay, and there's another chapter on there.
So you're like Ben Bernanke. Bernanke specialised in Great Depression. You specialise in housing bubbles.
And that's where I first started the thesis on, then it evolved to something else and looking at irrational markets generally. And back in those days, it's funny, I've got one chapter called The Psychology of Investing. The term behavioural finance hadn't yet been invented, believe it or not, but some people were looking at it. But anyway, when you're looking at a bubble in anything, you need to see several things. One, that the price needs to have disconnected from fundamentals, so it becomes overvalued. Yes, Australian housing is on some measures still overvalued, albeit not nearly as much as it was, I reckon, around 2003 or in some cities around 2010. I reckon we've come down from about 25% overvalued to about 10 to 13 on my measures. So yes, you can give that one a tick, but I don't see any self-sustaining momentum. What typically happens in a bubble is that house prices, you need a run of rises, and people are getting into the market simply on the fact that they think that prices are going to continue surging, they're going to miss out. Now, I don't see a lot of that at the moment. I don't see easy credit. Now, this is very important. And whenever you look through bubbles, there's a guy called Charles Kindleberger, who wrote the book on bubbles. He certainly is. Money is Panics and Crashes, I think it was called. And anyway, one of the other things you normally see is easy money flowing into the particular asset that's got the bubble. I don't see that at the moment. I see housing credit growing at less than 5%, which is close to a record low. Now, fair enough, that will probably pick up, and I think it appropriate that it pick up, but it's not the 20-odd% that we had back in 2003, when you certainly had a bubble in Sydney, in the Sydney and Melbourne property markets, and it's not the double digits we saw in the latter part of last decade. So I don't think what you're seeing at the moment is a bubble. Yes, the risks are there; it could become such, but I think it's a bit rich to be getting into all this hype about it right now.
One of the points that Christopher Joy from AFR and Yellow Brick Road made last night was that banks are very vulnerable because there's only about $1.50 worth of cash to every $100 of loans. He actually said that there's a very low, cash to debt ratio. Now, is that something that has come on your radar?
So he's not talking about the deposits. He's talking about the cash that the banks hold as capital. Or?
Yeah.
I don't know about that.
Yeah.
Like, if
he's
you
basically saying that if he gets defaults, the banks are going to be very, very exposed. And, you know, and
are they?
well, that's why I've got Rudy looking at what the analysts are saying, because the analysts should be looking at those sort of key metrics about, you know, what is the ratio of indebtedness to cash in the capital base.
Well, yesterday, and the latest debate in the last couple of days has been set off by the Reserve Bank's Financial Stability Review. Yeah. They put out, I think, a 68-page document, which I spent time reading on the plane up to Port Macquarie. And you read through that, they seem fairly relaxed. You know, why are bank dividends so high? The payout ratios are quite high, the dividends have gone up, because the bank's capital ratios are well above minimum levels. So in other countries around the world, they've had to raise capital because they don't have enough capital. Our banks have more capital than they need, even with those minimum ratios, which are actually going up as a part of a global regulatory change. So I don't see a problem there. Likewise, when I look at the Australian banks, the default rates are very low. Measures of financial stress in the housing sector in Australian households are all running at fairly low levels. So I don't get this idea that we're running wafer thin margins or whatever it is. I don't really see what the issue is there.
All right. Well, what about the fact that if the Reserve Bank cut interest rates again because they don't like the Aus dollar rising, they want to try and stimulate the businesses out there that will ultimately create jobs down the track, is that a high risk, cutting interest rates and therefore feeding the housing bubble? Well, you must be thinking about that conundrum.
Yeah, I'd have to say there is a risk there. If you keep cutting interest rates, there is a risk you'll feed the housing boom, or housing strength, which we're already seeing. But by the same token, I think there's a balancing act here. The Reserve Bank has to think about the broader economy, and it would be thinking that if we don't get the broader economy picking up, then the unemployment rate will rise more than
and that causes a housing problem too.
And that means more job insecurity, and could ultimately lead to a situation where this housing strength sort of starts to roll over again. So I think at the moment, come the October meeting, the Reserve Bank's going to do nothing. But they probably still have a bias to cut, if anything. If they're going to do anything, it's more likely on the downside than the upside. But they'll be weighing all these things quite carefully.
Do you reckon Glenn and his team would be praying for the Fed to start tapering, so maybe the greenback goes up, Aus dollar comes down, and then they can just leave rates where they are?
It will make life easier for them. I think a lot easier if the Fed starts tapering. They could say, well, the global economy is picking up. That's good. The US is slowing its stimulus. At the same time, pressure's coming off the Aussie dollar. So therefore, there's less need for us to do something. So I think the one thing that has to happen for the Reserve Bank to cut again is the Aussie dollar to stay where it is or keep rising. But if it's come back down again, then I think it does take pressure off the Reserve.
Do you think there's a rate cut out there, Shane?
Well, I sort of wax and wane on this one. I sort of think, all the way down, I've said we need to cut more. On Sky, I've said this lots of time. In fact, people were accusing me of just talking about interest rates all the time. So,
well, it's a big issue.
A bit like you.
Well, it's a big issue.
They had to come down. They were too high. Now we're sort of getting towards the level where I think we're either at or very close to the bottom. And it's sort of something I don't jump up and down about anymore. I think there's probably, maybe 40% chance of another cut, but 60% chance we're probably about there. And the reason I say that is that you're seeing the housing pick up, wealth is flowing through the economy again, household wealth is going up, shares are up 20-odd% on a year ago.
Yeah, even with Wall Street going down, we're going up.
That's
love to see that.
Interesting thing. Maybe there's a catch-up going on there, given our market's underperformed for a while. But it's got rising wealth. I think we're going to see the rise in house prices. Joe Hockey said it the other day, that sends a signal to home builders to build more homes. And before the election or post the election, a bit of both, I think, we have seen consumer and business confidence go up. So all of those things tell me that we're in the early stages of a pickup in the economy, which I think will become more evident through next year.
Yeah, and I think it was Malcolm Eddy made the point, or it might be just a Reserve Bank note, that when house prices rise, it actually could help a lot of the people who've been desperately trying to sell their houses on the Gold Coast, for example, and haven't been able to find buyers. That actually can help their balance sheets and actually help the position of banks where they could be facing a default situation.
Well, that's right. It takes a lot of pressure off.
Yeah.
So what I like here is that we have gone from that situation where a year ago we were worried about a collapse. We seem to be coming through the mining slowdown sort of okay.
Yeah.
Certainly that's what the message.
That's not a slump, it's a slowdown.
It's a slowdown, and certainly that's the message from the share market. The share market is saying, yes, profits right now are weak, but down the track there, maybe next year profits will start to pick up.
Yeah, and also banks aren't entirely stupid. If someone comes and they're borrowing too much and they know that interest rates could go up 2 or 3% over the next 3 or 4 years, well, that's going to be a very vulnerable customer. They probably won't get the loan.
They won't give the loan. There has been stories on that in the media how the banks are applying that test that you got to be able to service your loan even if rates are 2% higher. So I don't. All I see here is a Reserve Bank doing a bit of jawboning. They're saying, well, this could become an issue. We're not overly concerned at the moment.
Did you say jawboning or joy-boning?
We'll go down the path. Okay. But it's good old-fashioned jawboning when they say to everybody, just remember here that prices aren't going to be going up at double-digit rates. In fact, they aren't at the moment. I don't know where that number came from. But and people, therefore, when they go into the property market, need to have realistic expectations. I think that's a good thing
Without a doubt, without a doubt. Mate, thanks for joining us on the program. See you in a couple of weeks' time.